Hello and welcome to today's webinar, a joint presentation between LexisNexis and Archer, talking about ESG, Operation and Business Resiliency, and International Viewpoint. My name is Michael Nelson. I'm the Senior Product Specialist for LexisNexis Regulatory Compliance Solution, and today I'll be joined by Gerald Nunez, Senior ESG Specialist for Archer Asia Pacific. If you'd like to follow us on LinkedIn, feel free to use your phones to access our accounts through the QR codes on the screen. Today's discussion really deals with the issues that organizations are beginning to see in relation to ESG. We'll run through an overview of what ESG is and what it might mean to you, what's happening around the world, and then we'll look at how you can manage your ESG compliance obligations through the lens of the Archer solution. For those who don't know, LexisNexis has been around for the best part of 200 years in various guises. We started publishing legal research in London in 1819, and over the course of the best part of the last 200 years, that's been predominantly our focus. More recently, in 2016, we formed the view that the kind of people who are very good at producing meaningful commentary for the legal profession in relation to case law and legislation would also be very good at producing meaningful commentary in relation to legislation, prudential standards, and so on in the compliance space. Over the course of the last 6 years, the LexisNexis Regulatory Compliance solution has expanded globally, and we're now in a position to share the benefit of the wisdom of our legal experts in relation to ESG.
Thank you, Michael, and thank you to everyone for joining us today. Archer is a leader in the enterprise risk industry with over 20 years experience in delivering enterprise risk management solutions and services. Our leadership position is well documented, having received 24 straight leadership positions in industry reports across multiple categories, including the latest Gartner Magic Quadrant reports for IT risk management, IT vendor management, and business continuity solutions. Archer is highly experienced in the implementation of risk management solutions, having delivered over 1,800 deployments across all domains of risk management. We have a diverse global customer base ranging from organizations with less than 1,000 employees through to global multinationals, including 92 of the Fortune 100. We continue to invest in expanding solutions for risk and compliance professionals, including our latest ESG solution, Archer ESG Management. I thank you for your interest and attendance at the webinar today.
Thank you very much, Gerald. So let's consider what ESG entails. It's a three-letter acronym that I think everyone who's basically involved in compliance, risk, and governance has really been made alive and aware of over the course of the past couple of years. One of the questions that people often have is, what does it mean for us? And I think the simple fact that ESG is broadly applicable to any sort of organization means that that's really not an easy question to answer. Different organizations will face different kinds of climate risks, including depending on the individual circumstances of particular businesses, relating to the size, the industry, and of course the location of the operations. Obviously, for example, businesses in the agricultural sector in New Zealand are preparing to manage the impact of rising temperatures and unseasonal weather events, whereas organizations that work in the financial services space will be looking to see what's happening in relation to the legislation that passed earlier this year. There's a broad range of factors to consider, and not simply the initial climate change factors, but the knock-on effects that will result from our failure to address global warming. Organizations need to consider what might happen in relation to the provision of resources, supply chain issues that flow from that, instability of the markets that you might rely on, increased regulation, of course, labor shortages, and changes in consumer demand and preferences. Failing to address the climate risks that we clearly face will have serious ramifications for businesses. An organization's capacity to be adaptable and dependent on knowing how to address these within the context of their organization is key to managing the impacts of climate change for those organizations. As demonstrated by the impact of COVID on global businesses, knock-on effects can have an incredible impact on businesses that don't respond to change in a timely and responsive manner. Finally, of course, there's the social impact. It's not just organizations that are being brought to pay attention to the issues arising from the ESG space. More often than not, customers are also beginning to look to organizations to take a leadership role in dealing with these particular issues. And organizations that don't pay the adequate attention that they deserve will face reputational loss, loss of competitive advantage, potentially flowing down the road of shareholder activism, and eventually investor disinvestment. So, with that context in mind, what does ESG provide to you? Now, ESG reporting is a form of non-financial disclosure. And ESG, as I'm sure people on the call are alive to, discloses the organization's performance in relation to its environmental, social, and governance impact through both qualitative and quantitative measures. The reports evaluate risks and strategies and opportunities that exist in relation to ESG matters. Presently, and generally speaking, ESG reporting is optional. However, as we'll see, more and more jurisdictions, New Zealand, Australia, and across the globe, are looking to formalize and regulate ESG reporting, and certain aspects of ESG reporting have already become mandatory in some countries. For example, ESG reporting will be required for select public interest companies in the EU from this year. Now, the ESG impacts that are commonly addressed in an ESG report include a wide variety of things, including greenhouse gas emissions, climate change, biodiversity, human rights, labor conditions, privacy, and so on. What it all boils down to is your capacity as an organization to consider more than the single bottom line and look at the impact that your organization has at a global level. Implementing an ESG reporting system will obviously bring numerous benefits. It will bring you a clear idea of what your organization does. It allows you to establish and work towards your sustainability goals. It provides greater accountability and transparency for stakeholders, including shareholders, business partners, consumers. It allows you to clarify the extent and nature of the ESG impacts that the organization has and highlights areas that might require attention. And finally, it enhances the organization's credibility and reputation as a leader on sustainability issues. So, what sort of metrics do we need to consider when we're looking to prepare ESG reports? Generally speaking, the things you need to consider are these. What areas of your business have an environmental, social, or governance impact? And what is the nature and extent of that impact? What risks or potential opportunities do these impacts create? What strategies do you have in place to meet the risks or take advantage of the opportunities? And are those strategies sufficient? What goals does the organization have in relation to its ESG impact? What infrastructure do you have or need to put in place to measure those impacts? And is your existing data adequate to that need? You also need to consider who the audience for the ESG report might be. Like, who does the organization want to read its report and what do they want to take away from that? Also, one need to consider is the risk that clear ESG reporting might pose. What information are you not willing to disclose as part of this broader report? And finally, how are you going to report those disclosures? Are you going to use an existing ESG framework, and there are myriad, or are you going to develop your own? Organizations need to consider content, form, and delivery of the report, as well as operational managers, including budget, resourcing, record keeping, and so on. Now let's turn to the frameworks. As again, I'm sure people on the call are aware, there are a lot of different ways that you can report on your ESG. Frameworks, whichever one you choose to adopt, give you a structure for measuring and also communicating your ESG impact. A wide variety of different organizations have created frameworks for reporting on ESG, including the Climate Disclosure Boards, or Climate Disclosure Standards Board, the Global Reporting Initiative, the Sustainability Accounting Standards Board, and the International Integrated Reporting Council. Some organizations use other benchmarks or standards, such as the UN Sustainable Development Goals or recommendations on the Task Force on Climate-Related Financial Disclosures, TCFD. Now, there's a broad variety of approaches and methodologies within these different frameworks. Some are industry specific, while some can be generally applied. Some may emphasize environmental factors over an organization's social or governance impacts. What you need to consider when you're adopting a particular framework is which one is best suited to your particular organization's needs. Now, let's look about what's happening around the world in relation to this particular space. Across the world, notwithstanding there are a variety of different approaches, really there are three key areas that policymakers are focusing on. The first is company disclosures to make sure that investors have the necessary information to allocate capital. The second is investment product disclosures so that people can easily identify which products are more likely to allocate capital to sustainable activities or activities that can make the journey to sustainability. And finally, the issue around taxonomies, something that is clear across the world that will set out what sustainability actually is. So at an international level, in November last year, the IFRS Foundation trustees announced the creation of a new standard setting board, the International Sustainability Standards Board, or the ISSB. Now, the intention for this board is to deliver a comprehensive global baseline of sustainability-related disclosure standards that give investors and other capital market participants information about companies' sustainability-related risks and opportunities to help them make better decisions. In March this year, the ISSB released two draft standards, IFRS S1, or General Requirements for Disclosure of Sustainability-Related Financial Information. This standard aims to prompt companies to disclose ESG information accurate and relevant enough to provide a good window into their risks and long-term health and help investors make better informed decisions regarding the company. The second standard, the IFRS S2, or the climate-related disclosures, which establishes a framework for companies to disclose information about its exposure to significant climate-related risks and opportunities. These exposure drafts will be open for public comment until the end of July this year. Further to this, in April this year, the ISSB also announced a new working group, including representatives from China, America, the UK, the European Community, and the EU, as well as the Japanese Financial Services Authority. The purpose of this working group is to encourage enhanced compatibility between the ISSB's exposure drafts, which are currently open for comment, as I mentioned, and ongoing jurisdictional initiatives on sustainability disclosures. So if that's what's happening globally, let's look at some particular jurisdictions around the world now. So in EU, they're developing a taxonomy to define what activities are considered sustainable. Companies can use this to report on the sustainability of their activities as per the CSRD, or the Corporate Sustainability Reporting Directive. Asset managers are using this information to report on the sustainability of their products as per the Sustainable Finance Disclosures Regulation. In the UK, they've been rolling out mandatory reporting in line with the TCFD across companies and financial services. The principle is that with TCFD, the market can see where most carbon is emitted and allocate capital accordingly. But as sustainability is broader than climate change, the UK regulators also unveil plans for sustainability disclosure requirements that will expand the TCFD to include, as yet undefined, sustainability factors. Now let's turn to America. In the US, the focus has been a little bit different. In autumn of 2021, on Northern Hemisphere time, of course, the Department of Labor issued a proposed rule entitled Prudence and Loyalty in Selecting Planned Investments and Exercising Shareholder Rights, which appears on its face to be intended to make it easier for Employee Retirement Income Security Act fiduciaries, pension funds basically, to consider ESG factors without violating their fiduciary duties. Further to this, in February this year, the Department of Labor issued a request for information on possible agency actions to protect life savings and pensions from the threat of climate change, basically the climate RFI. The RFI has listed 22 specific questions seeking information about ways that climate change may impact the retirement industry and whether the Department of Labor should take additional broader action to protect reserve plans from climate change risks. Submissions closed in mid-May, but at the time of recording, we haven't actually received any response to those submissions. In China, their first ESG disclosure standard took effect on the 1st of June this year. The Guidance for Enterprise ESG Disclosure, published by the China Enterprise Reform and Development Society, includes a corporate ESG disclosure indicator system with 3 dimensions: environment, social, and governance, and provides a basic framework for that disclosure. Guidance also specifies disclosure principles, indicators, requirements, applications, and supervision for enterprises of different types, industry, and sizes. In Australia, we're taking a slightly different approach. While discussions about mandatory ESG reporting are well underway, ESG is largely voluntary for Australian companies. That notwithstanding, there are a range of existing statutory requirements that require disclosures to be made in relation to certain ESG-related topics. Non-financial disclosures that are currently required in Australia include modern slavery, workplace gender equality, and national greenhouse and energy reporting. What's interesting is that the focus in Australia in relation to ESG tends to be looking more at the financial services industry. So the ESG reporting guide was published by the Financial Services Council and the Australian Council of Superannuation Investors. That has given people a nudge as to what they should be looking at. Likewise, the Australian Prudential Regulation Authority, APRA, has published Prudential Practice Guide, CPG 229, dealing with climate change and associated financial risks. ASIC has also joined the party by releasing an information sheet on greenwashing, Info 271. The info sheet is addressed to responsible entities of managed funds, corporate directors of corporate collective investment vehicles, trustees of registrable superannuation entities, setting out how they can avoid greenwashing their financial products or investment strategies to avoid presenting as though you're ESG compliant while at the same time not necessarily adhering to the spirit of ESG reporting. What's interesting in Australia is that we've adopted the TCFD recommendations regarding reporting. And while voluntary disclosure is encouraged, I suspect that in Australia we'll see more and more legislation roll out under the new government that will tighten adherence to those sorts of reporting issues. Finally, in New Zealand, most people on the call will be aware of the Financial Sector Climate-Related Disclosures and Other Matter Amendment Act 2021. As I'm sure you know, the Act amends the Financial Markets Conduct Act, the Financial Reporting Act, and the Public Audit Act, and requires around 200 or so large financial institutions covered by the FMC Act to start making climate-related disclosures. Like the UK and Australia, reporting will be in line with the TCFD disclosures across companies and financial services. So people who are, or rather organisations who are caught under this regime are expected to publish disclosures from financial years commencing in 2023, subject to the publication of climate standards from the External Reporting Board. Now, the goal of the mandatory climate-related disclosures is to ensure that the effects of climate change are routinely considered in business, investment, lending, and insurance underwriting decisions, to help climate reporting entities better demonstrate responsibility and foresight in their consideration of climate issues, and to lead to more efficient allocation of capital and help smooth the transition to a more sustainable, low emissions economy. According to the Ministry for the Environment in New Zealand, the new disclosure regime will be gradually phased in. In the first stage, the XRB will prepare, consult on, and issue new reporting standards for businesses required to disclose. Reporting commences in the second phase, 1 year after royal assent. However, in the third phase, elements of disclosures relating to greenhouse gas emissions will be required to have an independent assurance associated with them. That, I hope, has given you an insight into how different jurisdictions are travelling around the world, all potentially under the umbrella of the ISSB. Given there's such a range of scope and potential pitfalls in play, it makes sense to find a solution that I think will help you manage this superlatively. And so I'll pass you over to my colleague Gerald, and he can talk you through the Archer solution.
Terrific. Thank you, Michael, for your update on regulatory changes to both Australian and New Zealand compliance requirements. It's great to know that Archer customers can rely on LexisNexis's insights and reporting to ensure that they remain up to date and at the forefront of these changes. Before I start my presentation, however, I'd like to share a brief background about myself. Yes, I am a salesperson. However, I started my professional career as a tax accountant and advisor, starting within a big six firm, or at least there were six firms back then, before moving into in-house tax roles within ASX listed as well as multinational organizations across a number of different industries. As many of you may appreciate, complying with regulations is not always as straightforward as what is presented within a piece of legislation, a ruling, or a practice note. Many hours are lost finding data sources, collating and manipulating data, as well as validating data before you are even in a position to formulate the data into a reportable form or return. Accordingly, I appreciate that the challenges that many of you with us today are required to negotiate just to do your job. This was why I moved into sales and where I try to demonstrate to compliance and risk for professionals what may be achieved through technology so that you can focus on your true priorities, whether they lie within or outside the office. Therefore, my presentation and demonstration today will focus on the day-to-day practicalities of trying to comply with ESG, sustainability, or climate-related disclosures and how you could potentially manage these within your organizations. As Michael noted early in the presentation, ESG can cover a variety of topics as listed on this slide. If you have time to read over some of the frameworks available today, you will note how diverse and challenging ESG really is. It is important to remember that ESG evolved from the study of the impact of sustainable practices on organizations' financial performance. The term ESG was first introduced in the 2005 report, Who Cares Wins? And a year later, the Principles for Responsible Investment, or PRI, were established by the New York Stock Exchange, which in turn led to the creation of ESG investing. Accordingly, ESG is not a new phenomenon. Despite all the reports and findings indicating that good sustainable practices have a positive financial impact on financial performance, it wasn't until the UN Sustainable Development Summit in New York in September 2015 that a framework for ESG reporting was first established. What is important to note when reviewing an ESG topic or metric is that each is relatable to an organization's business operations. Any change to how an organization utilizes or does not utilize a resource or raw material has a direct impact on its operations and its financial performance. This is where ESG risk comes into play and why is it important that regardless of your organization's size or reporting requirements, that you are at the very least aware of these ESG topics and their potential impact to your organization. So, why should you care? Let's take a look at some of the players. At a global level, we have the UN. Closer to home, we have the governments of Australia and New Zealand. We also have change leaders in the governments of the UK and the European Union. We have external accounting and auditing reporting boards, as well as ESG reporting standards and frameworks. We have financial regulators as well as stock browsers. There are also industry bodies. And finally, we have Joe and Jill public. In the age of social media, the public is becoming increasingly important and militant. I don't know if any of you have seen any of the TV advertisements by BHP or Glencore spruiking their sustainability credentials and their investment in renewable energy and sustainable mining practices. However, it should be noted that if companies like these care enough to spend millions of dollars to demonstrate their ESG credentials, then perhaps it is worth taking notice. It has been noted that proposed climate-related financial disclosures are providing a skewed view of ESG as they focus predominantly on the E. Climate change continues to be a global challenge and therefore has more universal support for urgent action. However, this should not deter you from collecting and reporting on other ESG metrics from the social or governance spectrum, as these may still be materially important to your stakeholders. However, for the purposes of this presentation, let us focus for the present on climate, as this is where most organisations are publicising ESG declarations. In particular, if we consider the emissions reductions that have been proposed at a global as well as a local level, it is clear that every organisation, whether they are government, non-government, private or public, will be required to reduce their emissions at some point in the future in order to achieve the targets have been set. The proposed requirements in New Zealand are interesting in the sense that they have a very narrow focus within an industry that some would argue does not emit large volumes of greenhouse gases. Perhaps financial entities have greater capacity and experience to manage the change in reporting requirements. However, we should assume that the net will widen and other industries will also fall under New Zealand reporting regime in the future. Will Australia take a similar approach? It's difficult to say. However, we have a history of competition with New Zealand and our government has a stronger standing. Accordingly, I suspect that Australia's regime will be more inclusive from the onset. Globally, we have seen a number of different approaches to making organisations accountable for sustainability practices. In Korea, for example, public corporations with assets exceeding 2 trillion won will be required to report on ESG from 2025. Other stock browsers in the region are taking similar approaches. Financial institutions around the world are creating ESG funds or ESG loan books for ESG investing. And there's a number of large multinationals that have announced that they will only transact with suppliers that are consistent with their own sustainability policies and practices. Over time, your organization's ESG credentials will become increasingly important, and the only way to consistently report and measure these is through standardized reporting. As noted on my previous slide, many organizations have made declarations about being net zero. Most of these organizations have timelines through to either 2030 or 2050. Accordingly, in addition to a reporting requirement, your organization may also be open to ESG risk. In practical terms, what does this really mean? Well, if we look at the following example, Company A has declared that it will be net zero by 2030. In addition, the CEO's report notes that the organization's corporate objective is to increase revenue by at least 8% year on year. If you do the math, this translates to double the revenue whilst reducing emissions to zero, all in a little over 7.5 years from today. How? What's the strategy? What projects have been identified to assist in reducing emissions? Does the technology even exist? Has it been proven? Is it accessible to your organization? What will it cost? Are there plant, inventory, or other assets that may be retired or sold? What materials or processes may require modification? These are all questions that are pertinent and need to be asked within your organization. And if the organization is unable to meet its stated objective, will the organization be required to purchase carbon credits, or potentially pay a carbon tax or some other financial penalty? Will your organization be able to secure favorable debt terms, or will it pay higher interest rates for not meeting emissions targets? And how about staff and talent? Will it cost more to hire and retain staff because of your loss of reputation? These risks may impact your organization's reputation, operations, and/or resilience. In addition, these targets have relatively long timeframes through to 2030 or 2050, which creates greater uncertainty and risk. Further, if you review the sustainability leads within most organizations today, most do not come from either a compliance or risk background. Instead, you will find a mix of professionals with backgrounds in either investor relations, marketing, human resources, safety, procurement, sustainability, or engineering, with arguably little practical experience in relation to financial disclosures, compliance, or risk management. So before you try and manage ESG risk, you need to understand whether any ESG risks exist within your organization and what these may be. I suggest a practical approach and begin by addressing your organization against its peers. What is the competition doing? Have they published an ESG or sustainability policy? Have they produced an ESG or sustainability report? You should also make an assessment of your organization's operations. Where does it operate? Does the industry in which your organization operates have any red flags? For example, is it a high emitter, unsustainable practices, low engagement with women, Indigenous, or diversity groups? Initially, this can be a relatively simple back-of-the-envelope assessment. However, if after your initial assessment, you believe that there may be some stakeholders that would be interested in your organization's ESG compliance, then the next step would be to validate what are your stakeholders' most material ESG concerns. The insights from your stakeholders will provide you with the context with which you select an appropriate ESG reporting framework and the respective ESG metrics thereafter. Again, as noted earlier, your ESG reporting framework may be broader than your organization's climate-related financial disclosures. Also, as a business, you should decide on what metrics you should be collecting in order to assess and manage ESG risk versus ESG reporting and compliance. This is very similar to management accounts versus financial accounts, in that the business needs to understand its ESG position and the risks and opportunities that this represents, and not merely collect data for external reporting purposes. From our discussions with customers, we understand that most share a number of common ESG challenges in relation to materiality assessments. These are critical to selecting the most appropriate framework and metrics. Metrics and targets, finding who in your organization can assist in providing data and then collating and reporting said data. Transition planning, what projects your organization is undertaking to meet its targets. Risk management, managing and quantifying the associated ESG risk within your organization. Compliance, i.e. reporting controls, review and assurance, and finally sustainability reporting, which is basically reporting of your ESG data. Depending on your organization's ESG maturity, some of these challenges may be more immediate than others. However, we believe we have the solution to manage all of these within a centralized, standardized, repeatable process. So, where should you start? First, understand your organization's requirements. Regardless of your organization's regulatory requirements, you should still make an assessment of ESG and how it relates to your organization. If ESG is not material to your organization, then stop here. However, you should revisit this position from time to time and reassess. Once you have validated the most material ESG topics, select an appropriate ESG framework. Step 4, select your ESG metrics and engage with the business to identify data sources and owners of that data. Next, implement an ESG reporting program, which allows for more frequent data collection, for example, on a quarterly or monthly basis. And lastly, assess your organization's transition plan and begin modeling the associated risks and their potential impacts. I will now take you through a brief overview of the Archer ESG solution, highlighting the LexisNexis Regulatory Compliance obligations functionality within the enterprise risk platform. As noted earlier in my introduction, Archer is a complete integrated enterprise risk solution suite comprising enterprise and operational risk, IT and security risk, audit and compliance, business resilience, third-party governance, and ESG reporting and risk modules. Each solution comprises years of learning and expertise in the governance and risk domain, providing our customers with best practice solutions for each use case. Today's demonstration will focus on Archer's ESG and compliance solutions, and sharing with you how LexisNexis's embedded regulatory compliance solution can help Archer customers identify an ESG control requirement, and kick off the implementation of an ESG program. LexisNexis's ESG regulatory compliance content can be added into Archer's compliance and assurance module. LexisNexis provides users with practical guidance with respect to the ESG subject matter. Including an overview of reporting requirements, standards, and assurance considerations. In addition, customers can also review consequences for non-compliance and other remediation options. In addition, customers can review and zero in on specific regulatory requirements and begin to assess these risks against their existing controls. Users can conduct a gap analysis with respect to their obligations and their associated controls. Policies and other underlying metrics. ESG policies, controls, and other underlying metrics can all be managed within the Archer solution. Control gaps are highlighted, informing users of where actions are required. And having all of your compliance and ESG data within one solution greatly simplifies the compliance processes in ESG risk management. Using Archer's holistic approach, users can monitor and report compliance at both regulatory and reporting standard levels. Compliance is connected to each respective obligation, with each obligation then connected to a control. Control performance can then be measured and reported for further action by the user. Each level of control can be rolled up, allowing users to monitor various levels of compliance throughout your organization's hierarchies and respective business units. And data from your ESG program is also integrated into the solution, providing the user with a complete view of the ESG risk and associated controls. Let's now take a look at a very basic ESG requirement and how Archer provides its customers with the tools to run a materiality assessment through to the selection of an ESG reporting framework, identification and collection of ESG metrics, and reporting thereon. The first step in implementing an ESG program is assessing the materiality of ESG topics within your organization. The results of your materiality assessment can be collated and presented visually for ease of understanding and internal reporting. ESG topics can be easily identified for further action. And materiality assessment questionnaires can be set up within Archer and automatically sent to material stakeholders to conduct the assessment. Returned results are automatically aggregated by response type, for example, internal versus external stakeholders. This provides the business with documented proof of what your material ESG topics are and where your ESG risk sits. Having identified material ESG topics, users can then select an ESG reporting framework from within the solution and an appropriate set of ESG metrics on which they wish to report. Archer can assist in the aggregation of the data or collection of the data through integration with other solutions within your organization or from internal or external parties outside of your organization. All of the data collected within the solution is available for further analysis and reporting. And all of the data is automatically aggregated per your organization's reporting structure, providing a clear view of all ESG reporting metrics by business unit, site, or country. Unit measures and other reporting metrics can be configured within the platform to match the organization's reporting requirements, which greatly simplifies the reporting process. And ultimately, Archer will help your organization automate and standardize its ESG and sustainability reporting processes. Enabling your organization to implement and establish a fully auditable ESG program. Archer ESG enables its users to run a complete ESG reporting process within a single solution and seamlessly integrate your ESG reporting program into your compliance controls, thereby giving you and your organization a complete view of how ESG initiatives are helping your business. Having all of your ESG data within the one solution also allows Archer users to conduct probability modeling using the data collected. This provides users of the solution with real-time insights with respect to your ESG risk profile and potential financial exposure due to missed transition objectives. A complete ESG end-to-end solution in a single platform. ESG Regulatory Compliance, Risk and Reporting, delivered by LexisNexis and Archer. And that concludes demonstration of the product. I guess we have a little bit of time for some final thoughts. So I guess, Michael, I'll throw over to yourself initially. If you could share with us, I guess, a couple of final points for the viewing audience.
Thank you very much, Gerald. And thank you to everyone on the call. I really appreciate the time that you've taken to engage with this incredibly complicated topic. Hopefully today you've got an insight into the kinds of issues in play, the kinds of ways that different organizations and different entities around the globe are dealing with it. And hopefully you can see a way through with the LexisNexis Regulatory Compliance content and the Archer solution helping you to manage those processes and make what is a very complicated and difficult task as simple and easy as possible. Gerald?
Thank you, Michael. And for those of you that saw my presentation with respect to Archer, I guess my final thought will be assess ESG within your organization and make a real determination as to whether or not ESG risk exists and what that risk is. And from those conclusions, draw out a process and implement a program within your organization to start collecting ESG metrics and be prepared for any reporting requirements in the future. Thank you for joining us, and please contact us for more information and download your free ESG compliance kit from the website. Thank you very much and have a great day.